If you're a retail investor trying to grow your wealth through stocks or crypto, here's something you need to know. Your biggest risk might not be the companies you invest in. It might be the people making headlines, especially those with power, influence, and a direct line to the media. One day, Trump says he's pausing tariffs. Markets surge. The next day, he threatens them again. Markets tank. For most investors, this constant flip-flopping creates chaos. But for a select few, it creates opportunity. In this video, we're going to break down how Trump's comments on tariffs and crypto influence the markets, why most investors shouldn't try to play the game, and what you can do instead to protect your money and your peace of mind. Let's start with the pattern. This isn't new. Throughout his presidency, and now even after, Trump has used tariffs as a tool, not just of economic policy, but of negotiation and media control. For example, in 2019, during the US-China trade war, Trump would often tweet threats about imposing tariffs on Chinese goods. Markets would drop instantly. Then, a few days later, he'd suggest talks were going well and stocks would bounce back. In August 2019, Trump announced new tariffs on $300 billion worth of Chinese goods. The S&P 500 fell more than 3% in a single day. Just a week later, after hints of a pause, the market started to recover. This back and forth continued for months. The media called it headline whiplash. But behind the scenes, traders and hedge funds were making money on both sides, buying low during panic and selling high on relief. For regular investors like you and me, it created confusion and losses for those who panicked or tried to time it. And it's not just tariffs. Trump has also made strong comments about cryptocurrencies. In 2019, he tweeted, "I am not a fan of Bitcoin and other cryptocurrencies, which are not money, and whose value is highly volatile and based on thin air." Within hours of that tweet, Bitcoin fell from $12,500 to below $11,000. More recently, Trump has hinted at either cracking down on crypto or supporting it, depending on the day and the political moment. These shifting positions create massive uncertainty, especially in a market that already runs on sentiment. For example, if Trump suggests future regulations or bans, expect short-term panic. But if he suddenly supports crypto-friendly policies, especially during campaign season, expect a surge. These are not small mood swings. They move real money. And unless you're inside the decision-making circle, you'll always be reacting, not anticipating. So here's where it hits home. If you're thinking, maybe I can trade these headlines and make a quick profit, think again. The only people consistently making money during this kind of chaos are those with early access to information. Powerful investors, insiders, institutions with direct political connections. They move before the news becomes public. As a retail investor, by the time you hear the news, the big players have already positioned themselves. You're chasing scraps. That's why trying to time the market based on political headlines is a losing strategy. You might get lucky once or twice, but over time, you'll lose more than you win. And worse, you'll invest emotionally instead of logically. So what can you do instead of trying to chase headlines or predict political mood swings? First, understand that volatility is part of the market. It's not going away. Smart investors don't try to avoid volatility. They build portfolios that can survive it. Diversify your investments across different asset classes: stocks, bonds, gold, ETFs, even some international exposure. Within stocks, spread out across sectors like tech, healthcare, energy, so one political move doesn't wipe you out. Use tools like asset allocation calculators or robo-advisors to keep your risk level aligned with your goals. Second, train yourself not to make investment decisions based on emotional reactions to news. Most political headlines are noise, not news. Create a rule. No trades within 24 hours of a major political headline. This gives your rational brain time to catch up. Set predefined triggers for buying or selling based on your investment plan, not someone's tweet. Use a journal to log your emotional state when you feel the urge to trade. If the reason is fear, walk away. Third, always zoom out. Headlines might shake markets for a few days or even months, but long-term fundamentals win. Use 5-year or 10-year charts when reviewing your portfolio, not daily or hourly ones. Automate your investing using dollar-cost averaging. This way, you invest consistently, no matter what's happening in the news. Review your portfolio only once a quarter, not every day. This reduces stress and reaction-based decisions. In the end, the market rewards patience and discipline, not prediction. You don't need to beat the insiders. You just need to avoid beating yourself. Political headlines will always exist. Trump may not be in office, but his words still shake the markets. You can't control what politicians say, but you can control how you react. Stay focused, stay informed, and most importantly, mind your money. If you found this video helpful, give it a like and subscribe for more grounded, no-hype investing insights.